So can we hear me properly? If you can hear me properly, please drop a message that you can hear me properly. Please let me know if you can hear me properly. Okay. All right, good. Thank you. Okay, so then we get started. Can hear you clearly. All right, thank you very much. So we're going to make use of, we're going to just do exactly the way we did yesterday, which I believe many of you found easy to deal with. Okay, so please confirm if you can see my screen. I'm sharing my MetaTrader 4, the platform. So that's where I want to work. I want to work from this empty page, just like we did yesterday. Okay, welcome, Chimezili. Okay, so welcome everybody. Golan Chineye, Staibere, Chibuzo. It's been long we saw Chibuzo. Then Alexander. Okay, it's been long I saw him too. Okay, Mr. Ibere says, how did I get that empty page? Yeah, what I simply did was, okay, let me use this as an example. Okay, this is white background. If I want to remove everything here, just go to properties and you just go to anything here, just everything, you just make it none, and then it's going to clear none and none. All right, foreground, none. And then what I need to do next is to change my, okay, can I see everything is cleared? So I can go to here and click and remove the grid. Okay, I don't think the grid is there anymore. Okay, just make it okay. Like, so that you see, it's cleaned off. So that's just the way I did. But here, instead of using light background, instead of using light for the other one, like the other one, I'm using dark here. Okay, so that's the way I did it. Okay. Okay, I hope all is well with you. Alexander says that probably okay. I hope all is well. Pray all is well with everybody. Okay, so we're going to look at indicators today, and there are some, people with different school of thought about indicators. Some people who are so much into charts analysis or price action analysis and all of that, they used to talk down on indicators a lot because they believe indicators are just mathematical puppets of the market. Let me put it like that. So because their appearance largely, or if not 100%, depends on the data that the price is printing. Okay. But for me, I don't think I'm going to subscribe to that. We still have people who make use of indicators. But for me, I believe indicators should be used from the context of the price action, of price patterns, of what the price is doing. So when we combine indicators with that, I believe that's the best way to use them. Okay. So let's look at indicators now. Now, indicators are simply mathematical representation of the market, or when you use the market, it's just like mathematical representation of the market on the chart. Then we now use those representations to analyze what the market is doing and then predict probably what the market is going to do next. That's what indicators are. Okay, so they are made from the price data. Okay, they are derived from it could be the closing price of the last 1 hour, the closing price of the past 7 days, stuffs like that. It could be a combination of the opening and the closing price. So it's just everything you get from there is still from the price. All right. So that's what indicators are. Okay. So let's look at example of some indicators. Okay, let's look at the categories that we have. All right. So the first category is what we call trend indicator. I know some of you who have attended this class before, you know what trend indicators are. Now, trend indicators are those that follow the trend. Okay, they are indicators that follow the trend. So we're not going to dwell on the mathematical formation or the mathematical development, okay, or the mathematical formula and makeup of this indicator. So we're just going to look at how to make use of them. All right. So trend indicators are those indicators that follow the trend. So example of such is, or let me say the most popular of them all is the moving average. Okay, the moving average, that is the most popular of them, of all the trend indicators. So the moving average follows the price. When the price is going down, the moving average starts going down, sloping down. When the price is going up, the moving average starts sloping up as well. All right. So, but we need to do some settings on this moving average. There are different types of moving average. We have exponential moving average. We have weighted moving average. We have the simple moving average and all that. You can either use any one of simple or exponential moving average. I'm going to show you how you can use all those things very soon. And then we're going to look at the kind of signals or the kind of information we can get from moving average. Okay. So let's go look at the moving average on the chart. Let's go look at that. So let's look at the Euro US dollar. Let's look at the Euro US dollar. So for you to get the moving average, you get the moving average. You can get it from here, which is indicators list, or you go to insert and indicators, or you right click on the chart window and go to indicators. I think we can get it here as well. Okay, I don't think they are here. All right, so you can either get it from insert indicators or you get it from here. Okay, this one is actually simple, just one click. So you click here and then you go to trend indicators. That's the first category. So we have different types of trend indicators. We have Bollinger Bands, Ichimoku, moving average, parabolic SAR, standard deviation, and other. You can read more about all these different indicators if you want to. Okay, but I'm only going to discuss with us the one that is most popular that almost every trader would like indicators, would like trend indicators, make use of it, and they use them in different ways. So that's the moving average. We're going to discuss about the moving average. So let me click on the moving average. So when you do that, you're going to get a box that will ask you more question, like what kind of moving average you want. Okay, so you're not going to set it. This one is period. Like how many days moving average do you want? Now, the big moving averages, the big period moving averages, they are usually used for long-term positions. Okay, long-term ideas on the market, long-term trend of the market. So like 200, 250, 300, and so on. Okay, while the 100 moving averages and the 50 moving average, they are usually for the medium term, but the 5-minute, 10-minute, 15-minute, and those ones are the short term. Okay, so the bigger the moving average, the farther it is it from the price. For example, let's look at the 200 moving average, and then we're also going to check 50 moving average. So I'm on 200 moving average now. I want to choose the exponential. You can use exponential or simple, and then apply to close. So I want my color. I can't use white here, okay, because I'm already on a white background. So I have to change the color to, let's say I want to choose blue. You can choose how thick you want it to be. You can choose whether you want a line or or dotted or lost. So this is okay for me. So let me click OK. So this is the moving average here. So it's just like a line that is sloping up and down, and it's moving just the way the market is going. So the market is sloping down, it slopes down. If the market is moving sideways, the indicator moves sideways as well, just like we have here when the USD was just moving average for many weeks. And price also went average to, I mean, sideways rather. And then when it moved up, moved down, and down and down. So you can see that the moving average is just following the price. But if and this is the 200 moving average. So if I use a much smaller moving average, that one is going to be closer to the price. If I use one that is bigger than 200, it's going to be farther away. Okay. So the higher the period that you choose, the farther away you get the indicator from the price, from the market. Okay, so let's say I want to get in another one, moving average, and let's say I want to do just 50. I can choose red so that I'll be able to distinguish between the two of them. I can choose red and I click OK. You can see this one is closer to the price than this one. Likewise, if I do, let's say, do 350, you can see that that one is going to be far away or farther away from, than this one. So you see that now. So that is the issue about the period. Okay, that's it about the period. So the higher the period, the closer, the farther is going to be from the price. So if you are someone who like swing trading or long-term trading or medium-term trading, you tend to look at the higher moving averages, higher period moving averages than the lower period moving averages. Okay, so that's the first thing you need to note there. Okay. All right. So let's now look at what the moving average can give to us, kind of information we can get from the moving average before we now talk about how I use the moving average. One thing we can get from the moving average is that the moving average tends to help us, give us some direct buy and sell signals. Okay. And that is one of those things we were taught at the beginning. When people talk about moving average, that's like the most popular thing they talk about. And which is when the moving average, let's say, okay, let me remove this one. And let's say we are dwelling on this 30 moving average, 50. Let's go to 1 hour time frame. So we're going to see it properly here. So the idea is that when the moving average cuts the price upwards, if we break above when the price breaks above the moving average, that's like a buy signal. Okay, that's what a lot of people, you must have heard this one way or the other if you have been under any moving average class, especially in the past years. All right. And then when the price cuts the moving average downwards, it's like a sell signal. When it cuts it up, buy, cut it down, sell, buy, sell, that kind of stuff. Buy, sell, sell, buy, sell, buy, sell. Okay, so with this, you'll see that you're going to get a whole lot of trades. And one thing about this is why personally, I don't think one should be looking at, one should be using indicators, this indicator this way, is that you tend to get a whole lot of false signals, especially when the market is not trending. Okay, when the market is not trending, you're going to get a lot of signals that will not give you profit, will most likely result into losses. Like here, look at how many times the price cut the moving average here. 1, 2, 3, 4, 5, 6, 7, 8, 9. And price was just moving sideways. It was like the 10th time that we now got a movement. Okay, so that's the first thing. That's why it's not really advisable to just trade moving averages this way, that when price breaks, you buy, when price breaks, you sell, wherever. So that's the first thing. And then the second thing, and which is actually the major reason why the moving average gives a lot of false signal, is that before the moving average gives you this kind of signal, the price will have moved significantly in a particular direction. Like here, before when price broke above here, you can see the price has already moved well. Also here, when the price broke above here, you can see price has already moved well. So if that trend is not a strong trend, you might not really be able to get something sufficient before price turn around. Okay, So it's a lagging indicator. All right. Trend indicators are usually lagging indicators. Okay, especially the moving average. They only respond when the price has moved in a certain direction. Okay. So that's the first thing we need to note about the moving average. I mean, very, very important. So now having said this, now how do I trade the moving average? I use it two ways, okay, which I'm still going to talk to you guys about. No, we already talked about support and resistance yesterday, and we said that support is when price is going up. Let's just quickly remind ourselves what we said about support and resistance. So let's say price is going up and it gets to a particular level and drop. We said that is a what? A resistance level. Now, the indication of this or the implication of this resistance or the usefulness of this resistance level in the future is that when price gets here, we can use some strategies to trade. We can either wait for a fake breakout, all right, which I explained to you guys how I used to do it yesterday, but I didn't really give so much detail about it. So that's going to be in the intermediate class. Or when price breaks above significantly and pull back into it, and then we can then buy, okay? Or when price pushed up like this, we have a support, okay? So the next time, let's say later, this move started coming down, well, the market is going to remember that this is a support because a lot of traders are looking at this level. As when price gets here, we're going to activate our two strategies there. The first one is it could be a fake breakout and then we buy. Okay, the second one is it could be a complete break, a successful breakout and a pullback, and then we sell. So these are like the two key ways of trading around support and resistance, which are very, very, very viable. Now, the same way you trade support and resistance like this, you can also make use of the moving average as your support and resistance. So apart from the horizontal support and resistance created by the price itself, the moving average can also act as a support and resistance. Don't forget that the calculation of the moving average is still from the price itself. So the moving average is not a third party stuff that has been introduced. They're just mathematical formations, okay, from whose data are derived from the market itself. All right. So the same way you use horizontal support and resistance, you can also make use of moving average as support and resistance as well. So how do you do that? Let's say you have price in red like this, and then you have indicator, the moving average indicator is also moving up, right? Until after a while, price now breaks below the indicator. Okay, or let's say price comes to the indicator. When price comes to the indicator, it could actually act as a support. The indicator can act as a support, which can then project the price upwards. All right. Or price could break below the indicator. And while it's doing that, the indicator is also trying to reshape itself and also start to moving down. Okay, because definitely it's going to move with the price, but it's just that it's going to lag. Price will move first. And so as price is moving down, the indicator is moving down as well. And we already have a breakout from here. So this is a complete breakout. So might then have a retest of this level before the price goes down. So that's another breakout pullback continuation. Or it could even be a fake breakout here. Okay, that means price could actually break out and quickly goes back inside to give us a fake breakout. Or it could be a sharp rejection of here. So that means that this indicator is also acting as a what? A support. So the same case for when the indicator is acting as a resistance. All right. So that is one thing. That is one way that I use these indicators. And so let's look at the chart and see some examples there. Okay, because whatever we do, we can always see it on the chart. Even we're going to look at different moving averages. So this is the 50-day moving average. Look at what happened. The price broke out and pulled back. When it pulled back, it made what? So when it pulled back, it made what? Fake breakout and then push up. it comes back to it again, provided support, it moves up. Now it's giving us another one here, breaking slightly below it. If we quickly push back again, that will be a fake breakout. So you can see that the indicator there is acting as a level of support here for this bullish trend. So for this bullish trend, it's acting as a kind of support. All right. So, and as price comes in, make a fake breakout here, is pushed up. This one also a minor fake breakout pushed up, and another breakout here. So, but we have to see whether it's going to be a complete breakout, then wait for a pullback. At that point, the indicator can now act as a what? As a resistance. So, my make another move down. But at the moment, what we are seeing here, with what we are seeing here, if the price goes back upward again, that's going to be a fake breakout, and then the price can then move further upside. So that is a very good way I use this indicator such that it won't give me lagging information or lagging signal. So in this way, I'm not getting the lagging signal, okay, because I'm joining the market when at the end of a correction. So it's also very useful when the price is trending. Yesterday, we talked about trend, correction, trend, correction, trend, correction, trend. So that means when price is breaking upwards, breaking higher highs upward, while the lows are getting intact. Okay. Now, one of the, yesterday I said that we can't really exactly know when we're going to get a new support on the previous high is broken, right? So, but one way we can predict that before we finally see a confirmation is the trend line and of course the moving average. So we just put our moving average there, okay, because price could actually go there, make a bounce or make a fake breakout and push up. Okay, in as much we've not really seen a break of structure, the break of the bullish structure. So that means the bullish trend is still very much intact. So you can see the way in that case now we are trying to use the indicator together with the word price action. So we're not just using the indicator alone, just taking it as a price value. So we are trying to use it to read the market in the best possible way the indicator could do. All right. So that is the first way that I use these indicators. Okay, this moving average indicator. Maybe we should look at more example when the price is going down. Okay, so look at this one. Okay, price goes down, fake breakout, drop downwards, fake breakout, drops downward, fake breakout, drops downward. This one was a proper breakout, pullback, push up. Price comes, fake breakout, but it didn't really work well here because price just went sideways. You know, we said that this is a trend indicator and it works best when the market is trending. Okay, so it didn't really work out well here. Okay, because price was just moving sideways, and didn't work out well as well around here because price was just moving sideways. So, but look at the trend here. Price breaks up, downward, sorry, and then make a fake breakout, push down, comes there, a perfect rejection, push down. This one it breaks out, pull back, but couldn't really continue. And then it moves up here. Okay, we've not really seen an established trend here. It comes down here for a retest, fake breakout, but eventually it broke downward. So it just kind of give you an idea of how you can, where you, we can use it as a support and resistance level where your correction could end. Okay. So that means when the price is going up, for example, you can have, let's say price is going up this way. At least you can have a tool that can help you to anticipate where the pullbacks or the correction could last before the price continues to go upward. Okay, so we can use our moving average as one of the tools to find where the correction within a trend could end or where the pullbacks within a trend could end, so that we can then continue with the trend. Okay, look at this one example here. Look at the fake minor fake breakout and then look at the very big push up. That's a very very good example there. Okay, so that is the first way that I use them as support and resistance. In fact, I've even discussed the two ways. Okay, use them as support and resistance, and of course use them to identify the end of corrections within a trend. Okay, I think I've explained the two of them. So when the market is trending, you can use a moving average to identify where the correction could end, likely places where the correction could end, but you must be careful. I mean, you should use this when the market is trending. Okay, these are other examples here. You can see as it's acting as resistance here, resistance here, resistance here. And as price is just breaking downwards, you can see break of this low, price goes down. We have this high. Okay, this high has to be kept intact if the price is going to continue to go downwards. And then when price was making this correction, we have the moving average. We'll have been anticipating rejection at this moving average for the end of this pullback. It happened. And another one here, but eventually we had a break below here. So this is the new high. And then, but here it failed actually. It failed here. Okay, so it couldn't provide the necessary resistance here. And eventually price broke above the most recent high. So when it broke above most recent high, we could also start seeing higher highs and higher lows here. So which means that these lows are being kept intact, which is an indication that we are still within a correction. And then when price make this move, it came back here to make a correction. But the fact that it's still above here, all right, is an indication that the bullish move is still very much intact, although it's a correction. And then when it comes here, the indicator provided support and price pushed up, eventually broke above here to terminate this bullish trend. And then we can say this is, I mean, to terminate this bearish trend, and then we can say this is a nice bullish trend. All right, so so that's just, you know, you can see the way I did that. I'm trying to use this, okay, together with the price action plus the indicator. It works best like that. Okay, so another person you might also want to use, this is the 50-day moving average. Okay, another person might want to use maybe the 100-day moving average. Okay, but what is going to happen is if I use the 100-day moving average, it's going to be farther away from the price. Okay, so which means that for the 100 moving average, if price is going up like this, sometimes those places where the 50 was able to provide a resistance, the 100 is going to be far away from there. Okay, so the 100 will not provide resistance there. And those places where the 50 fail to provide support, the 100 might be there to provide it. So it's all down to you choosing the best one that you want to work with, whether it's 100 or 50 or 200 or 300 or so. Just that the higher the time frame, the higher the moving average period that you choose, the less the signal you're going to have, and then the less the false signals that you're going to have. All right, the less the false signals, and also the less the general number of signals you're going to have. Okay, so personally, I like using the 200 to 50. I like using three moving averages, 200 to 50, and then the 300 moving average. Okay, in this case, not just one, but I use like two or three. And then there is one other indicator that I now use to support the end of that correction. Okay, so that's it about the moving average. So does it make sense to you guys the way I explained it? So does it make sense to you? Please drop a message. Let me know if it's good, if it's something that you think it's cool. There are different ways people use moving average, so, but that's the way I use it. That's why I like to use it. You can do more studies, okay, to find out. Maybe you can, or just do those studies on the chart yourself. Maybe you're going to find a way that you want to be using it. Okay, so nobody's is nobody knows all. All right, nobody knows all, so you can also find out. All right, so what do you guys think about the explanation of this moving average? Let me know, please. So the next one we want to look at now is momentum indicator. I'm here to get any message. Can you guys hear me? Okay. All right. Thank you. Okay, so let's look at the other moving average, the other category of moving average. Now, the other category of moving average, what we call the momentum moving, the other category of indicator, is momentum indicators. Okay, or we call them oscillators. Okay, while trend indicators are lagging indicators, momentum indicators are said to be leading indicators. So which means that they don't exactly follow the price, just like the trend indicators follow the price. Okay, they don't exactly follow the price. Sometimes they get to a particular level and they wait for the price to turn around. Okay, so that's why a lot of people like using them as leading indicator, okay, so to speak. Okay, so that's why a lot of people like using them as leading indicators. I was trying to read you guys' message. All right, so now the thing about oscillator is just oscillators are just like let me say a band. So it's like when the price is moving up and down, you now create a bound, kind of boundary, upper boundary and the lower boundary for the price. You use an indicator, okay, to create upper boundary and lower boundary for the price, okay, which means that when the price is trending up, okay, you're going to see the indicators moving towards the upper boundary more. All right. Also, when the price is trending down, you're going to see the indicators moving towards the lower boundaries more. And so that's why when the price gets to the upper boundary, the simple explanation that a lot of people believe the indicators give is that the price, that bullish move has become stretched out. So they call it overbought, that the price is overbought. That means when it comes to the boundary here, upper boundary, it means the price is overbought, and then they can then what anticipate a bearish move. Also, we also have the lower boundary here. When the price comes to the lower boundary, because it's not going to shoot below the indicator is not going to shoot below it. When the price is coming down and the indicator comes to the lower boundary, the indication is that the price is oversold, and we're going to see a move up. That's just the indication, okay? And we have a lot of people who also would like making use of the momentum indicators, and we have some good momentum indicators one can use, okay? But I don't use it the way every other person out there use it. I use it together with the price action. I use it together with the price action, okay? Now, let me also state that momentum indicators, you can use them two ways. Okay, before I talked about that two ways, let me talk about the boundary. Now, the momentum indicator is being constructed to range or to be from 0 to 100. All right. Yeah. So the 0 is the least level, while the 100 is the highest level. So it's never, the reading is never going to be more than 100 if the price is trending up, and it's never going to be less than 0 if the price is trending down. And a lot of time it doesn't even get to 100. A lot of them it doesn't get to 0, but a lot of time get really, really close to them. So that's why one shouldn't really just focus on 100, but you can create a boundary, or let's say like 70 to 100. Some people use 70 to 100 for the upper boundary, and then 0 to 30 for the lower boundary. All right. While we have some people who use 100 from 75 to 100 for the upper boundary, and then from 25 to 0 for the lower boundary. I'm going to show you how to do those settings. And then we have people who use who are more conservative about this, they use 80, all right, 80 to 100 for upper boundary and 20 to 0 for lower boundary. Okay, so once the indicator is reading between 70 to 100 or 80 to 100 or 75 to 100, they consider it as overbought. Likewise, when it goes down to 0 to 30, 0 to 20, or 0 to 25, they consider it as a lower oversold and prices expected to go up. Okay, that's just a basic, simple explanation a lot of people give to it. But there are two ways that I make use of this, this indicator, which I'm going to show you soon. Okay, so two ways. Now, there are two ways you can use this. The first way is you can use it during a sideways market or a range market. In fact, that's like the best way. Okay, when you want to take this at a face value, something like this, or this when the price move between the upper band and the lower band, when you don't want to take it as the face value, overbought and oversold, then you look for a sideways market. All right, market that is just ranging up and down, up and down, up and down. Okay, which means that if the price is moving sideways, and sideways means it's going up and then start coming down, then goes up again, come down again, go up again, come down again, go up, come down, go up. You'll see that it's just within a range. Okay, so that's a very good way of using the momentum indicators. All right. So, which means that when the price is moving sideways, you've confirmed a sideways behavior, okay, of a particular chart. Then you go to your moving average, I mean your momentum indicator. Then when price gets here to the upper boundary, the upper range, okay, when the price gets to the upper range, you confirm the upper boundary on your indicator. So when price goes to the upper boundary within this range, you also try to confirm it with the upper boundary within the momentum indicator. So most probably you're going to see the momentum indicator also reading overbought, and then that's a signal to sell. The same way when the price is moving to the lower boundary or prices within the lower boundary of the range, and then the oscillators is reading oversold, is giving you oversold reading, and that's going to be a buying opportunity. Okay, that is how to use the momentum indicators when the market is moving sideways. But when the market is trending, you can't use it this way. All right, you can use that, which I'm going to show you. I want to just lay down all these examples before I show you. When the market is trending, you can't use it that way. The thing is, the reason is when the market is trending very fast and the trend is still very strong, what you see the indicator do is that the indicator is going to go up to the, let's say this is the upper boundary. It's going to go up to the upper boundary. Let's say this is where we have, when price got here, indicator has gotten here. Now, when price is moving up, instead of the indicator to also shoot up, it just move within the upper boundary like this. It just stays in there. It won't come down. It's just going to be staying there. All right. Now, if you sell, because you see an oversold condition, an overbought reading on indicator, that's going to be a loss. The reason is that the price is trending up, okay, and the trend is strong. So you don't trade overbought, oversold, and all that when the market is trending. There is a way you do it, which I'm going to show you, okay. But when the market is going sideways, that's when you look for overbought and oversold reading on your indicator. All right, and then you can buy and sell, okay, and then you know how to exit the trade. So let's say price gets to the overbought region, and indicator also, and let's say indicator gets to the overbought region, and price get to the upper range, you can sell. If you sell, where do you exit? You exit when the price is getting back to the lower range, because price is within a sideways move. When it gets to this range, you can also go back again, so that you not lose the profit that you have made from that. So that is when the market is moving sideways. So when the market is trending, you don't do it that way. because you're going to get a lot of false signals, a lot of them. You're going to lose a lot of money. But how do you use it when the market is trending? All right. So let's really look at that. Now, when the market is trending, let's say in this case, it's trending down. The market is trending. You know, we say when the market is moving down in a bearish trend, you're going to be seeing some pullbacks or maybe even corrections in the upward direction. And the market is moving down. Now, when the market is trending, the best way for you to trade the trend is to wait for the end of the correction and sell. Wait for the correction and sell. Wait for the correction and sell. That's the best way to trade a trend. Okay. You don't trade trends when trend is at the middle or it has moved so strongly and you're now joining. That's a wrong way of trading the trend. Okay. Unless you want to scalp, pick 5 pip, 10 pip and go up. You want to really trade that trend, you have to wait for the end of the pullbacks or the end of the corrections and then join the trend. All right. And I already told us the moving average can provide us the likely place where the correction could end. It can give us some kind of resistance here. Even the trend line can also give us some kind of resistance. But aside from that, we can also use the momentum indicator to confirm that this pullback or this correction have ended. All right, that's what we can use them for, the momentum indicators for, in a trending market. Okay, price is going down like this and it makes a correction. What do? You're going to look for overbought reading on your oscillators or on your momentum indicators. Price goes down, is making a correction. You're also going to look at what? Overbought reading. Going to look at overbought reading. When you get an overbought reading and price reacts downwards a bit, then you sell. Okay, so you can see how we are just these two indicator type and trend analysis, how we are using them side by side, we're using them together. All right, so that's how you do. You trade your indicator together with a price action. Okay, so let's do this all together as a whole, together with trend analysis. So let's say price, let's say this is where we have the oscillator. Let's say this is the upper boundary. Let's say this is the lower boundary. All right. Okay, let me use something better and get something better for that. So let's say this is the upper boundary. All right. On the oscillator, and this is the lower boundary. On the oscillator, let's say this is, this goes way back. This one also goes way back. So this is momentum indicator. And let's say now this is the price. Let's say this is the price moving. All right. So you have the price up, you have momentum down. Now, when price is moving down like this is making lower low, lower high and all that, you are also going to see the indicator getting right here. The indicator is going to get to the oversold condition. But are you going to buy here? No. You're not going to buy here because the price is trending down. Okay. You're only going to buy when we get the next correction. Right? We'll get the next correction. Okay, let me use just one line. Yeah. Price moved down. Then the momentum indicator moves down. Move to the oversold condition. You're not going to buy here because price is at oversold. You can only attempt to buy when you realize that it's a range. When you realize that it's a trend, you don't do that. So what do? You wait for correction. So when the price makes that correction, then you can confirm the correction with the momentum indicator, because chances are there that the momentum indicator will then go back here. Okay, the momentum indicator will then go back here. That is when you can now sell. That's when you can look for selling opportunity. Okay, because you are using the momentum indicator to confirm the end of a correction. You don't use momentum indicator to confirm the end of a trend. Okay, when the market is trending, you're going to, and you're using the indicator to confirm the end of that trend, you're going to get a lot of false signals, FOLSE. When you are using the momentum indicator to confirm the end of a correction, then you're going to get better signals like that. It's not going to be much, but it's going to be far better and profitable. Okay, with combination with, combined with other stuff. So it's then we can now look for a sell, a move down. Okay, so at the same time, you're going to have the indicator come back here again. When it comes down here again, are we going to buy? No, you're not going to buy. Instead of that, we wait for another correction, right? And so when you get another correction there, chances are that the indicator has also gone up. And at the end of that, you then look for another sell. All right. You then look for another sell. So indicator has come here, and then you look for a sell. When you look for a sell, price has come down here again. Okay. And so that's just how you're going to do it. Okay. Until the trend gets exhausted. Okay. So you have up, down, and just like that. Now let's now say we now get the start of a correction and price breaks above here. We now have maybe high, low, high, which is a change of price structure there. So what you're going to most likely going to get here is price goes up and down like this, and then a push up to this place. Now, the fact that price has broken here, you might not really want to look for a sell opportunity there. Okay, you might just maybe wait for more confirmation, because with price trying to change structure here, it might lead to further move up. Okay, so the only time you are going to look for another set of buying opportunity after the break of the downward structure is to wait for price to make one more move and wait for the next correction and then sell. So which in the case here, price is going to go down like this, come up here, and then you sell. Okay, so with that, now you are trying to just follow the price. So when you have a correction start, you need to, before you can sell, you need to wait for price to reestablish the downward move, and the minimum is a move down and a move up. Okay, so that's just the case there. But let's say the price has broken above here, all right, and goes up. So which now means that this is also going to go up, maybe remain up more, a little bit upwards, and then now makes another correction. And after making that correction, this will have gone here. Then what happened? We can buy. If it makes another correction here, this one goes down, we can buy. The only time we're now going to sell is we have to wait for the break of the last low here. When it happens, which is this, then wait for another correction, this, and then we sell. So that is how you use the structural development of the market, trend analysis, okay, with the momentum indicator. Okay, with the momentum indicator. So for those, if we're having issue with this, please watch yesterday's video. It was yesterday we discussed this break of structure, market trending uptrend and downtrend, and the transition from trend to correction and all that. So yesterday we talked about that. All right. So this requires a lot of practice. You have to practice. I said you need to spend some time practicing. You need to spend really, really good. If you don't practice, you are not going to get all these things. All right. So you learn it, you watch the video again, and then you practice. You see things for yourself. So it's not about just what somebody told you. You have to see things for yourself. Okay, so having said that, so what we're going to do next now is talk about the different indicators that we have, the different momentum indicators. Okay, and the basic thing we're going to do there is to look at their different overbought and oversold levels, because that's like one of the things that they are very useful for. And that's what we have discussed so far today. Okay, so let's go back to this place. Let me remove all these ones. So to plot your momentum indicator, you come here, the indicator list, then you go to oscillators. So we have, there are actually like two that I use, but there are three good momentum indicators. We have the moving average convergence divergence. We have the relative strength index. We have the stochastic oscillator. Right, those three other ones are useful as well, but those three are the ones that I've used are very well, and they're really, really very useful. Okay, so we have the RSI, relative strength index, we have the stochastic oscillator, we have the MACD. Okay, so the difference, okay, let's look at each of them quickly, one after the other. Let's start with the RSI. So on the RSI, you can do the settings. So the period should be 14. All right, 14 is good. 14, but you can change it. It's changeable, but 14 is actually very good. Apply to close, just leave it like that. And then the color red, and you can fix it, fix it from 0 to 100. Okay, that's what makes it an oscillator. So you leave it like that. Then you go to levels, and then you set your overbought and oversold. Now for relative strength index, I'm good with 70-30 overbought, oversold, or oversold, overbought. Okay, I'm really, really good with it. Okay, so, and then I do, okay. And so you can see it's 70. So anything above 70 is overbought, and anything below 70 is oversold. All right, this is the 4-hour time frame. And if you look at the 1-hour time frame, it's going to adjust to that time frame. All right. Okay. So if we also look at the relative strength let's look at another indicator. If you want to compare them. So look at the oscillator, and then you go to, let's look at another preferred one. That's relative stochastic oscillator. For stochastic oscillator, I use 75-25 or 80-20. Okay. So let's parameters. Okay, 10-3-3. Now this is not the default setting for the stochastic. This is not the default setting. So I like using 10-3-3. Okay, I've worked with 10-3-3 for over 6 years, and it makes more sense. It makes a lot of sense. Okay, it's kind of smoothing the oscillator very much better, and then you can leave every other thing the way they are. Okay, so I do okay, and so this is the oscillator. Now for the RSI is just one line. All right, just one line that just goes between the on 0 and 100, 0 and 100, or slave between 0 and 100. Why this one is also between 0 and 100, but this one is like 2 lines. Okay, let me do some editing here. Oh, I think I've actually deleted it. So let me go back to put it on trend. Okay, sorry, oscillator and stochastic. As it. Okay, so I want to also make this one tick. Okay, so like this one, and maybe I make this one another, maybe make it black. All right, so black and red. So the red is a signal line, while the black is the main one. Okay, now this one, now it's also like between 0 and 100. Okay, and that's one other thing I want this overbought and oversold line to be tick. So I want to adjust this 25 and 75. Let's go there, properties, and let's go to levels. So I want the level, it's silver color. Silver color is good. I want it to be tick, and let's do okay. All right, cool. Sorry, maybe I should make it black. The gray color is kind of faint. Make it black. Okay, cool. So you see that now, so that's good. So one thing you are going to see, let's look at the difference between the two of them. We said this one is just a line. And then this one is, you have 2 lines. But one thing you're going to see is that the stochastic is faster. It's faster than the RSI. The stochastic is faster than the RSI, as at least with these settings that I have, RSI 14 and stochastic 1033. It's faster. Like here, when the stochastic cross into the overbought region, what happened to the RSI? RSI is still way away from it. Okay. Now, but later the RSI went this up, and this one still continued to go up. So which means that the RSI is going to give you less signals than the stochastic. The RSI does not rush quickly into the overbought, oversold region, okay, compared to the stochastic. The stochastic goes there faster. So which means that if you want more signals, you look at the stochastic. But if you want more quality signals, but less in terms of number, then you look at the RSI. So the RSI seems to smoothen out the fake overbought, oversold, all right, than this one. Okay, meanwhile, the downside to that is that the stochastic will give you, there are sometimes if you use the RSI, you are going to miss out on some good trades, which the stochastic is going to give to, because stochastic will have read that while the RSI wouldn't have read that. All right, so it's all just up to you, the one you want to use. Okay, but oftentimes what I do, if I want to use stochastic, what I do is that in order to make it match up close to what RSI used to do, I usually use the stochastic on the higher time frame. So like I'm on the 1 hour time frame here. Instead of me using stochastic of 1 hour, I'll use stochastic on 4 hours. But you can't do that on MT4. You can only do that on TradingView. Okay. So with that, it's kind of better to use the RSI. Okay, in this case, because it's going to give you more better signals. It's going to give you better signals, but it's going to miss out on some really, really good signals that the stochastic will have picked. So if you are more interested in taking all of the signals possible, or you are more interested in taking more of the more quality signals, it all depends on you. So that's what is going to determine which one of this you're going to choose. All right. Okay, so let's say we want to look at, let's look at the price. All right, let's look at the price. Now, price has been trending up. You can see this nice trend up, up, down, then up. Broke above this recent high, in fact, maybe even here, to show that we've started a real correction. All right, and then also we can also see that we started an higher high move, okay, to the upside, an higher high, and then we are getting a correction here. And like I said, when you want to trade, when you want to use the overbought, oversold stuff on the stochastic or on the RSI, the momentum indicators generally, it's good that you use them when the market is trending, then you wait for correction, or you use them when the market is ranging, and then you buy tops and sell tops and buy bottoms and stuff like that. But in this case, the market is clearly trending up, and then here we have a correction. Now look at so when that correction is going on, you can use the indicator, the momentum indicator, to spot when the correction is going to end. Now this first move downwards, you can see that was when the RSI, the stochastic, gave us a signal. We'll have bought, but it will have been a losing trade. When you look at the RSI didn't give us any signal. The moment it got to this 30, which signals oversold, that is when we got a signal on RSI, and then price just shoots up. That's the case. Now, this one will have given us two trades. One is a loss, one is a win. This one will have given us one trade, a win. Now, price broke above this high to establish the upward move, and then we add another correction here. Now, this correction here, what happened? This one gave us a signal, but this one didn't, because it didn't get to the oversold. A price shoots up. So that means we'll have gotten a signal here. Okay, maybe even get one false signal here as well, because when this tiny move happened, we have stochastic already crossed. Now, price has gone down again. The RSI has touched here on Euro US dollar, and with this now, that's a bullish opportunity on Euro US dollar. Okay, based on this, the way the market is moving and the kind of signals we are getting on the stochastic and the RSI. So the two of them are giving us signal. But when you look at the stochastic, will have also given us another signal here, which is this one here, right? Although it's really, really very tiny. Okay, this one is really the major one. So let's say we're getting the signal here, and we're getting another signal here. So look at the RSI. Within this upward trend, it gives us how many signals? Just two. All right. One very good. The second one has not even started the move, all right, yet. But look at this one, give us four, like five. Too good, too bad. Okay. At the end of the day, stochastic still aligns itself with the RSI. So that means any signal you pick on the RSI, you pick on the stochastic. But there are some signals that will be picked on stochastic that you will not see the RSI because the stochastic is faster. All right, stochastic, but it gives you more quality signals based on what we have seen so far here on this chart. Do you get that? Based on what we have seen so far on this chart. Here, we've not even applied any other thing. We just look at the trend and then the correction, the trend, correction, and stuff like that. Okay. So maybe we should look at another example so that you guys will see what I'm talking about. At least I think I've been able to prove that point now that the two of them are momentum indicators. They can be used for this kind of trend correction stuff, end of correction to move the next, to go with the next trend. But the RSI seems to give us, you know, more quality signals. All right, more quality signals. Why the stochastic gave us so many? Like here now, from here, look at all this one. How many times did they, from here, for example, from here, how many times did the stochastic touch the bottom? From here, look at it, one. This is the second one. But this one, how many times? 1, 2, 3, 4, 5, 6, and this is the seventh one. Okay, so have I made my point clear there? If I've made my point clear to you, please just type 1 or just type 1 so that I will know that I've made my point clear. Okay, let's look at another example. Okay, before I now tell you the third way that I use this indicator. All right. So we want to look at another bearish trend. Now, here is another bearish trend here. Now, in this bearish trend, in this bearish trend, one thing you're going to notice is that the pullbacks are very shallow. Now, when the pullbacks are very shallow, you might not get any kind of signal on the momentum indicator. The pullbacks are really, really very shallow, very, very shallow. But while this one didn't give us any signal at all throughout the move down, it never really came here to the overbought region. But this one still came here like once. Okay. So this one will still have given us signal, a very good one. All right. This one wouldn't have given us anything. So you can see the pros and the cons of the two. So one is not actually better than the other. It all depends on you, whether you want more actions or you want to be more reserved and take and focus on like the quality rather, instead of the quantity. But at the end of the day, you might still end up maybe having similar results. Okay. Okay, now look at this sideways move now, for example. You know, I told you guys about the sideways move that when the best way to use it is when the price comes here, you can see the sideways move, sell, buy, sell, buy. Price broke out of the sideways range, and then we now continue the trend. So sometimes when the price is moving, if it's coming down, it can go in a range, but eventually it's going to break out of the range, either upside to continue a bullish move, to resume a bullish move, or it can come down, all right, let's say in a bearish trend and go sideways and then breaks below breaks out of the range, and then continues a bearish move. So price moves from trend to correction, trend to sideways, and then back to the trend most times. So that's just the case of what we have here. Price was coming down, up, down, down, up, down, go sideways, broke upward, continue the bullish trend. Okay. So when the price make this up and down, yeah, the next thing is when price comes here, you have already established a top here, an upper range for the price, just around here. So that means when price comes back to this range, you can actually start anticipating an opportunity to sell downwards because it's within a range. Like I said, that's one of the ways of trading using this momentum indicators in a range market. So when price came here, that was a sell. At that time, this one gave us signal. This one was very close. And then we sold downwards. And then price came to this lower range also around here. And then we got this. The two of them gave us signals. And then that was a buy. Okay, but eventually price broke out and just goes up until it break the structure downwards and continue downwards again. So when you combine, you just try to understand what the price is doing, all right, by knowing the structural development on your charts. Try to understand how to read the charts, all right. That's what we are trying to read the charts and then follow a trend. Okay, it is always very important that you understand the condition of the market first, whether it's trending or not. Okay, there's another example here, and price was also in a bullish trend, up, down, up, down, up, down. But this one gave us a signal here. Can you see that? Then pushed up, but this one didn't. The price goes down. This one gave us another signal here, but this one didn't. Okay, so you understand what I'm saying now. So you just have to choose one. Just know that when you choose this one, let's say if you choose, I'm just give us an instance. Let's say if you choose stochastic may give you, let's say within, I'm just giving an example, let's say within a month, if stochastic give you like 15 signals within a month, that's just an example. I'm not saying that's what it's going to do. You maybe let's say you win 10 and then you lose 5. Okay, and let's say you're not use the RSI for the same. The RSI might give you maybe like 7, and then it could be like you win 5 and then you lose 2. Okay, so this one is 10-5. One is 10-5, 10 win, 5 losses, or maybe 9 wins, 6 losses, because it tends to give you more forcing. Let's say 9 wins, 6 losses. Okay, while the second one give you like 1 win, 5 wins, 2 losses. So you just have to choose which one which one you want to go by. All right, so I hope I've made my point there. Somebody said, Chinese, can we use both? No, you can't use the both at the same time. Just have to choose one. Now, if you're using both here, because eventually what RSI can do, this one can also do. Okay, but just that this one is faster. Because every signal the RSI picks, this one is also going to pick it. Okay, but there are signals this one will pick, this one will not pick, because this one is quite faster, okay, than this one. You just have to choose whether you want fast actions or you want slow, steady action. All right, so you just have to choose. When both agree, I just talked about that now. When both, there'll be a time when both agree. So you don't have to put them together, because when both agree means the RSI and this one agree. So it's still the same thing as just using the RSI alone. If both of them will agree, it's just like you're using the RSI alone. It's as good as using the RSI alone. What RSI gives you, stochastic will give you. But what stochastic gives you, RSI is not going to give you. So if you want to use the two of them together, that means you're only going to be taking trades that the RSI gives you. All right. So just a decision. You can also do more back testing to see how that works for you. All right. I've told you the way I do my own. I can either stay with the RSI or maybe pop this one a bit to make this one slower by using it from the higher time frame. All right. So just to make it a bit slower. Okay. So let's now talk about the third way of using this indicator. Okay. I'm not going to let's look at the third one, the third indicator, which is the MACD. All right. Now the thing about MACD is that the MACD is not it doesn't really doesn't really range between 0 and 100. So it's kind of a little bit different. So for the MACD, I like using, okay, the default is 1226 now. I've forgotten the settings I used to use, but I derived that setting from the Fibonacci number. I think it's, okay, I'm going to share that. Okay, let's go with this. Let's just go with the default. So let me make it bolder. Let me make these things bolder. And make this one blue or maybe red. Okay, let me make it black. All right. So you see now you can see this one is not really between, it doesn't really have fixed level. Like this one have fixed 0 and 100. This one doesn't have fixed level. It only has a 0 line. Okay, it has a 0 level and it has two indicators. I mean, two lines. Like this is the histogram, an histogram and a signal line. The signal line is in red. The histogram are just the normal statistics histogram. Okay, so the first signal is when they cross over. It means a sell. When they cross downward, sell. When they cross upward, buy. But let's look at the momentum. For this one now, it's not really very much good for overbought and oversold. So that's why I don't want us to talk so much about it. But there's also a way I use it, which we're going to look at that later in maybe in subsequent classes. Each of them have their best way of use. Okay, like this one, I like using this zero level reversal here. Okay, that's this zero level reversal. When price gets to the zero and then just push up, you see another zero level reversal here. So another zero level reversal. So if I want to use it, I've used the zero level reversal for my end of corrections. Look at price was going up, make a correction here, then we have the zero level reversal and they pushed up. I just hope I can see another good example. Okay, let's go to the front. We'll see a good example. Look at this one also. Price was going up, down, up. When you make this correction, you see another zero level reversal here. Okay, another zero level reversal. But instead of us just because overbought and oversold are actually clearer. So it's not just better to just stay with the overbought and reversal instead of looking at the zero level reversal. Okay, for the end of the correction. As you can see also, this one also moves as fast as the stochastic, but the RSI is much slower than the 2 of them. All right. So that's it. Let me remove the MACD. So the next thing we want to do now is to look at another way of generating signal on these momentum indicators, and that is what we call divergence. Okay, price momentum divergence. Price momentum divergence. Okay, so what that means is that now let's say we have our oscillator down here and price up here. Now, when the price is making series of higher highs, you're also going to see the indicator also making series of higher highs. Normally, when these one are making a series of lower lows, the indicator is also going to be making a series of lower lows. Okay, but there's something that can happen that can help us to use the relationship, okay, between these two, some kind of anomaly, some kind of divergence to spot reversals, okay? And it's a very, very good signal point. So let's say this one is going up and makes a higher high here. And this one is also going up. But when it gets to this top, instead of it to make a higher high, it makes a lower low. I mean, a lower high. Now, this one is trending up at the top, higher high, but this one makes a lower high. That's what we call a divergence. That is a reversal signal, okay, in technical analysis. So that means price is most likely going to fall, okay? We're going to look at different examples of divergence very soon. So likewise, when you have price trending down, and then at the end, it makes a lower low, And also the momentum is trending down also, but instead of making a lower low, it makes a what? A higher low. All right. So why this one is trending down like this at the bottom, this one is making a higher low at the bottom. That is a divergence. So that's what we call price momentum divergence. And when that happens, it means price will most likely make a move up. Okay. And just like I said again, I don't like using this indicator at the top of a trend. I prefer to use it in a correction. So let's say price is going down in a downward trend. And then I just see a correction like this. And then within this one, and I will now look for maybe a kind of divergence, okay, for me to signal the start of a bearish move. I'm going to show some examples of that. And what I'm just trying to say there is that I also use it from the context of trend correction, trend. Instead of me to look for divergence at the end of a trend, at the top or bottom of a trend, I look for divergence at the top or the bottom of a correction. Okay, so while the overbought, oversold can help us to identify the exhaustion of the correction, the divergence can provide us a signal for entry. Okay, because at the end of the correction, price is going down like this, makes a correction, and then when it makes that correction, the stochastic also, or the momentum indicator, enters into a what? An overbought region, which means a sell. Now we have a sell signal there, but we still need one or two things to apply for us to confirm the sell. One of those things we can use to confirm the sell is divergence. So if we see a price momentum divergence, yeah, that's a cool one. We can sell. All right. So this is an example of price momentum divergence. Okay, so price is sloping down, momentum is sloping up, divergence, or price is sloping up, higher high, and the momentum instead is making a lower high. That is a divergence. All right, that's a divergence. So that indicates a sell in this case in price. This one indicates a buy in price. Okay. Okay, so let's look at some examples on the chart. So we can also look at Euro USD. We can even just look at divergence. You look for divergence at the tops and at the bottoms. So look at divergence here. Look at the divergence here. Price was making higher high here. But what happened? Okay, let me make it tick. So you look for divergence at the tops and bottoms, okay, not just at the middle. Tops of a correction or tops of a trend. But in this case, I always want to use it for corrections. So you have this one trending up, making higher high. What happened here? This one is making lower high. What happened here? This one is also making lower high. That is the divergence. I can see the way price weakened. Another one here, actually. So we have price also making a lower low here. And what happened to the indicator is making a higher low. That is divergence. So this one gave us that. This one didn't really, okay, give us two actually. So you see that also, divergence. So divergences, they are very old. Like it's one of those things we learned when we started trading. So we have another one here. IRI, divergence here. You can see that. You can see the indicator. This one didn't really give us the divergence. Okay, maybe we'll look at it from there. But this one gives us a clearer divergence. So for divergence now, you can actually use different indicators, any of the momentum indicators. If one does not confirm, the other will confirm. So this one confirms the divergence, but this one didn't confirm the divergence. Well, so we can look for more examples. Do we have a divergence here? No. That's making lower lows. We're also having lower lows here. No divergence. Do we have a divergence here? Yeah, we have a divergence here. Higher high. And then RSI gave us a higher low. But this one didn't really give us. Or maybe we want to look at it like this. But this one is actually better because it's formed around the overbought area. So you can see that. So another one here. Price making lower low here, and the stochastic making higher low, and you can see the turnaround. Okay, you can see the turnaround there. So in this case now, price made a bearish move downwards, making a lower low, lower high, and all that. And then when it came here, you can see a correction there. And then once you spot this divergence, and you also see the indicators already giving us oversold and all, that's an indication that the correction might just be over. And then if you now see something like this divergence here, cool. That's an indication that the move is over, and then we can anticipate a move downwards. Okay. So let me. So that's just what divergences are. All right. You can go to your chart and spot different divergences. One of the things you can also use the divergence for is for you to know the maybe the when the correction is starting. Okay, so price is making an higher high and all that move. Okay, but according to our higher high, our trend analysis, we want to see a break below here before we see confirmation of the trend. But the divergence can help us identify that early, that there's going to be a move. I mean, a pause in the bullish trend. So if you see divergence at the top of a trend, just like we are seeing here, it means there's a weakness coming. Okay, so it's either you see a correction, or you see just a pullback. Okay, or you see even see a correction that could go deeper or lead to a change of trend. Okay, so divergences are really, really, really very cool momentum indicate in the momentum signal. All right. So what we are trying to do here is just to learn different components. I mean, components of the things we are going to use later. Okay, so it's tomorrow we're going to discuss a trading strategy that encompasses all of these things we have talked about, that encompasses the trend indicator, that encompasses the trend analysis theory that we talked about, that encompasses the momentum indicators, the divergence, and all that. Okay, so we put all those things together. Okay, so the situation is just like you want to go out hunting. You want to go out hunting, you don't just go with your bare end. Okay, as an hunter, you go with some weapon, you go with an earth torch. Let's say you want to go at night, right? You go with maybe spear, you go with knife, you go with gun. Okay, different stuff. Okay, so it's just the same we are doing. And if I want to go with all of this, you have to learn how to use them one after the other. Okay, you have to know how to use them one after the other. Okay, so that's just what we are trying to do. Trend analysis checked, momentum indicators checked, trend indicators checked, momentum divergence checked, the basics of trading checked, how to place trades and all those things checked. So tomorrow now we're now going to build a strategy that will make use of all these things. Okay, and then after that we now go into series of back testing to see how this strategy works. And that's just how to go about trading in a nutshell. All right, that's just how to go about it. And so although this is it's going to be a really very basic strategy, and in the intermediate class, just imagine what you can get in the intermediate class. In the intermediate class, you're going to have like two or three, like three different strategies. Not even three. You're going to learn chart patterns, how to trade them, the best way to trade them. Okay, the way I've seen them perform best over so many years that I've been using them, I've been following them up. I'm also going to learn how to trade price action. Okay, first breakout, or maybe a breakout pullback continuation setups. We're going to talk about that. So this one is a strategy. This one is two, with all the about 8 patterns. That's about 10. Look at that. So that's what we're going to get in the intermediate class. All right. So thank you guys. That's where we're going to end for today. I want to appreciate every one of you for staying through. I'm going to see you tomorrow. I'm going to take your questions now. Thank you very much.